Well, hello and welcome to Trading Blows, back after a summer break. Plenty for us to discuss on the show this week. We'll have a look ahead at what may lie in wait for markets over the remainder of 2023. We'll also look at a few nearer term issues as well, whether sentiment around China might be nearing a bit of a peak pessimism moment, whether the dollar can continue its recent bull run, and where the risks facing the equity market may lie. Without further ado, let's get into the show. So a busy show ahead with plenty to discuss. As always, our panelists will rack up points for the answers that they give. The better the answer, the more points they'll get. And if any dispute is raised over their answer, they do have the threat of points being chalked off looming over them. Joining us on the show this week as we come back from the summer break, Ioan Paisey in his garden, the founder of PiQ Suite. Adam Linton from a cave, head of the European desk over at Newsquawk. And last but by no means least, Ioan Smith, a veteran of the sell side and his own research firm. With the gents with us, let's get on with round one. So, of course, the proviso with giving people scores is that I can remember how the scoring system works, which is by no means guaranteed. But one thing hopefully we can all get our teeth into is the financial markets. So, Adam, I want to kick off with you. I mean, we've come through Labour Day this week, so I guess despite the weather here in the UK, we can all say that summer is pretty definitively over for the markets. What do you reckon we should have on our radars then for the last, 3.5, 4 months of 2023?
Yeah, so, I think the narrative towards the end of the year will be dictated by basically how the data unfolds mainly in the US. Central banks, they're very much in data dependent modes that will impact their reaction functions and therefore the narrative. I think over the summer months and past few months has very much been dictated by the soft/no landing scenario, whichever way you kind of wish to characterize it. But, I'm kind of the view that at some point this is going to have, gravity will return and things will pull back. If you look at some of the data points, if you look at JOLTS, for example, some of the PMIs, which I know some people discredit, but ultimately they're a more timely indication of what's going on than some of the other hard data. Then we also saw that spike in the unemployment rate for the most recent non-farm payrolls report. So these are potentially suggestive we could potentially be at a turning point. And I think it's how this kind of growth outlook aligns with what's going on in an inflationary standpoint, which is going to be relatively telling for the rest of the year, particularly as we've kind of mentioned in other shows that the journey in inflation for CPI year over year from 4% to 3% was a quick one, but from 3% to 2% it's going to be a slower one. So then if we're in a situation of potentially slowing growth, inflation's a bit stickier, do we kind of go from maybe a soft to no landing categorization to one of more kind of stagflation or stagnation? And the US has kind of been the poster child of the year so far. So if that kind of does begin to turn, then does sentiment overall kind of then begin to ratchet lower? And therefore, I think, the main way people will be kind of playing this will be the 2024 kind of rate cutting cycle, which is why, when you kind of mentioned the last 3 months of the year, I wouldn't necessarily, it's kind of like an arbitrary kind of point. I think people should be more honing in on the next inflection point for the Fed. Oh. So if you kind of assume that they've kind of paused,
fuck it, give him a few more points for that.
So I think if I think that's the kind of channel people should be looking at. I think the rest of the year isn't, in a way about the rest of the year. Is that the rest of the year is about next year.
Time is just a concept.
Exactly. Thank you, Ryan. I think. So then if US does go to begin to slow and it's kind of goes from being the positive outlier, do we kind of see a bit more of a convergence rather than a divergence with the rest of the world? And China, I think we'll touch on that in a bit, but if you take somewhere like Europe's in a real tricky bind at the moment. And in terms of running a European desk, I think my greatest interest is immediately is how the ECB manages next week's policy decision. You've kind of got this backdrop of slowing growth, but ultimately, have they really declared victory on inflation? If they want to see the actual realised data rather than relying on their forecasts, I think potentially that meeting next week is maybe a little bit underpriced at 25% or 30%, wherever it is. But, if they, from a central banking perspective, I think there is more of a case for them to continue hiking. But, the market will then see them as hiking into recession. It does that kind of, we get a bit more of a gloomier kind of end to the year than we've kind of had at the start of the year. And the thing is, if things do kind of deteriorate as well, is you've got to bear in mind the policy space we're in as well. So, at the start of the year, your policymakers, they're hiking rates, blah, 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 things are going okay. But in a normal cycle, if things are deteriorating, they can, make policy easier. But we're not in that space at the moment, because if they kind of allude to the fact they can make policy easier, their big fear will be, do inflation expectations begin to de-anchor? Could things get away from them? So you're going to essentially have to kind of stand pat. But then if they do that, then do we kind of get a return of kind of what we saw at the start of the year, where the market's priced a lot more dovishly, central bankers are trying to come across more hawkishly, and do you kind of get that cat and mouse game again? So that's kind of the way I've kind of framed the end of the year.
I think that's a very good framing. I mean, we've had the intellectual answer.
When are we going to bring in time limits for answers?
Well, I was just going to say, we've had the intellectual answer, so why don't we get the Ryan Paisey answer? What are you, apart from your upcoming big US voyage, what are you looking forward to for the rest of the
exercise to judge what the impact, what's really going on in the US economy? I'm going to go around and boots on the ground, get some real answers.
Absolutely, the best way to do it.
I agree with everything that my learned friend Adam. One thing I would like to ask Adam is, and when he mentioned PMIs, is what's your thinking on the base effects? Because obviously, neutral readings on PMIs neutral readings on inflation. Sorry, not PMIs. Inflation should be ticking higher purely on a base effects level. Do you think that that's going to add even more so? As in, do you think the inflation changes are all going to add on to that, so we could see some some shockingly big jumps, or do you think it's just going to be all in the curve, so to speak?
What do you mean, as in with regards to prices paid?
Yeah, well, with CPI and PPI, it's all the same. The base effect's basically going to say that neutrally we should be getting an extra bid to it. So
I'm not sure quite something good. So do you say PMIs?
I think we'll try. Forget PMIs. I don't know where that came from. I think what Ryan's trying to say is, if you look at the base effects in inflation from last year, they're basically flat. So if we see
PMIs,
I meant CPI. Sorry.
So if we're 0.2% month on month, then that's going to just mechanically lift the year-on-year rate.
I think, and the people have got to be prepared for that, right? We're not.
We saw the oil move yesterday, didn't we?
Yeah, but that's what I'm trying to get at. This, even without those factors, even if oil went sideways, we would still be getting a bid in inflation because of the base effects. That's what I was trying to get at. But look, forget it. Anyway,
on a headline basis, but core if it's pulling back, and then if we see some of the shelter effects kind of pull back as well, there could be mitigating factors, and you'd assume food inflation begin to pull back at some point as well.
There's re-acceleration and things like gasoline.
Same as what Ioan just said. So I think the food is quietly grinding higher again. You've only got to look out, look further east to rice prices and stuff in India are getting pretty silly again, and the export bans and whatever. It's all that malarkey. We're seeing it, those kind of bans and those kind of tariffs being pushed around. We've also seen this weather recently. I know Dickie's not with us today, but Dickie loves a bit of weather and agricultural products, and we're seeing some really shocking scenes out of Brazil, and they're taking some serious damage onto the crops of what was we're just tying up this current harvest. So and that's it's been a very good one, but at the same time, how is that going to last going forward when you see the damage that's been done recently? But anyway, that's kind of getting slightly off topic, I guess. Although maybe we could say that's something to watch for the rest of the year. But what I will just quickly raise is, on the geopolitical calendar, just a couple of things to keep an eye on. Not suggesting there's any trades around it, but just something to bear in mind. Obviously, we've got the Swiss elections end of October 22nd. Got the G7 Trade Summit on October 28th. Obviously, that's just rife for headlines, so something to bear in mind. We've actually got
Is that the one that Sunak's going to?
I'm not sure.
I thought he was going to try and get a deal on the sidelines with India.
I wouldn't be surprised. We're seeing some increasing number of headlines on that front, aren't we, on the whole India thing? And obviously India at the moment talking at the G20. So again, this is basically marking these out there purely because they will drive some headlines, and everyone loves a headline. So anyway, so the inaugural African Critical Metals Conference, they're trying to get them kind of get themselves aligned, almost like a rare earths OPEC, kind of what we're seeing with South America. They're kind of trying to do a lithium OPEC kind of cartel. Again, I'm not suggesting there's any trade on this, but what we will see is a ton of headlines all around the critical metals, which then obviously follow through into your China trade and whatever. I'm sorry, a helicopter. So then after then, we've got in early November, middle of November, 13th, 14th November, we've got the APEC Economics, Asian Pacific Economic Cooperation Conference Summit. Again, not suggesting any trade, but just have it on you have it on your radar. And then, what else we got to look forward to? It's China, it's all these different, which we're getting onto in a second, I know, so I won't go on to that too much, but there is plenty going on. Am I going to sit here and tell you, okay, this is going to happen then, and this trade here? No, we can't. There's too many moving parts at the best of times. It just feels like, even more so at the moment, where we're coming out of this kind of this everything's okay again, or maybe it's not okay. Again, speaking about Fed, ECB, and every rate setting meeting now is important to an extent. When you really only want to be looking at Fed and ECB, I think BOE still, it's not. Everyone's kind of almost put them over in a corner and said, well, let's just let the BOE do what they want to do. But we're seeing huge division in all major central banks from the policymakers themselves. So that's another reason why, one, the rate setting meetings are much liver than they've used to be. But more than that, the infighting means we'll probably get a lot more sources, comments coming out, and all those kind of factors kicking into play. But it's pretty
exactly, and that is why you need something like PiQ.
Well, there is that.
There's a give you a plug, and it got stuck in my throat. Why you need something like PiQ Suite or Newsquawk in order to stay on top of those headlines.
Just wait until you can get Newsquawk on PiQ Suite, then we're rolling.
There we go. Ioan, let's bring you into the show properly. What are you keeping your eagle eyes on for the rest of the year?
Yeah, I mean, the same there. You obviously have to keep China on the radar, given all the random headlines that we get out of there. But we'll obviously talk again. Japan's, keep surprising to the upside, but consumption started to contract there. So for the yen trade, you're going to keep an eye on that. The Eurozone's obviously dealing with two basically shocks in energy and China. So, but unlike in China, there doesn't seem to be any political will to support to issue any new supportive measures then. So when they all come back from the summer, we'll see if they start to get their act together. So, and obviously there's a risk that the monetary tightening cycle hasn't finished there either. But just a couple of maybe specific catalysts to look out for, especially from the US and on a dollar sense. There's, the consumption started to roll over a little. And what's interesting, I think student loan interest payments restart again next month.
Yeah.
So that may start to cut into, September spending and, the strong summer for the American consumer and the consumption numbers that we got out of there. So, eventually you'd expect, the economy there to be squeezed by those tighter financial conditions. We've also got the another budget drama to contend with as well. So we're going to get that. So that's the new fiscal year starts.
The US will not default, people. The US will not default.
I'm not saying that.
I'm not saying it to you. Sorry, I'm not saying it to you. I'm saying it to everyone else because we'll see a load of headlines saying.
No, absolutely. But just be aware that those headlines will hit, and just be aware that you can completely ignore them. You don't need to trade them, or you just trade the move. So, I mean, with regards to that, Congress hasn't made any progress. So a load of programs are going to have to be reauthorized when they lapse this month. And that includes, expanded unemployment benefits and things like that. So, You're going to get a lot of brinkmanship again, and I think you're going to get a lot of headlines from the United Auto Workers contract expiration next week as well. So they'll, if they strike, then that's going to impact output as well. So that'll impact the numbers into the
You just reminded me on the striking situation. I don't think Adam mentioned it either. Obviously, the LNG workers in Australia is something we should be everyone should be watching, because that could be locking in up to, I think the Chevron stuff is about 5% of global LNG capacity.
Yeah,
they're doing a walkout next week, I believe. But that could then follow through to a longer strike. On top of that, the Nigerians, who are a massive crude exporter, they're also doing a nationwide strike, and which I think they're doing another 2-week walkout again. But then after that, they're going to be doing an indefinite strike. So that, again, could apply more pressure. When you combine that with the output cuts headlines that we're seeing for Russia and Saudi, this could get, crude prices could get away from us without really much.
Yeah, again, all that feeds into the underlying as well. So you start to get prices moving higher again because of the scarcity value.
Yeah.
I think also about the strikes, the percentage that some of the US unions are asking for as well,
it's
the wage dynamics and follow through to inflation would also be kind of front of mind for policymakers as well.
Yeah,
well, we could just get the Bank of England to tax the inflation.
Jesus. I was already on edge after Adam had wound me up earlier around the pound being an emerging market currency, and then reading that in the FT. I mean, that just sent me over the edge at that point.
I mean, I have never read anything as ridiculous in my life.
And this Mike actually ripped his tie. He was so angry. That's why he's not wearing one today.
Oh, absolutely. I mean,
this guy's a bold statement from Ioan as well, because I WhatsApp him and he reads some tripe that I.
And this geezer is an advisor to Jeremy Hunt, which
wasn't he an ex-policymaker as well?
He was. Yeah. Mental. In any case, that brings us to the end of the round, I guess, and we'll move on to talk about China, which has already come up a couple of times. So, as I said, and well, as Ioan rightly said earlier as well, we just seem to be getting an absolute mess of headlines coming out of China at the moment, both in terms of negative economic news and data, and also in terms of stimulus. It just seems a very kind of scattergun approach to policy making that's going on over there at the moment. Ryan, I know China's your favourite subject in the world, so what do you make of all this?
Yes. Next question. So look, there's a couple of factors that everyone needs to bear in mind when you're talking about China. One is the known unknown, and by which I mean by that is no one knows what the real data is.
I knew he was going to say that. I was going to say it.
And he knew he'd get a point for it.
China, bingo, bang, the data's rubbish. We're off.
Well, right, but it's true. We all know the data is rubbish. So if the data is coming out poor, then God knows, what it really is. There was a report by, I think China, they've stopped releasing youth unemployment data because it was like 23% of whatever it was when they decided to stop doing it.
I was always more than that. It was double that.
No. It was officially 23%, but a professor that was quite senior in the government at one point put out a report saying it was up to 43% or something like that.
I think it's almost 50%.
Yeah. And that's the time that they kind of just pulled the plug on it. So I suppose you can't report bad data if you don't report any data, right? In regards to all these, we're seeing headlines every day. But in terms of different stimulus measures and whatever, but there's been a few kind of very smart people that have looked into this, and there's a lot of planned stimulus measures and support measures, policy measures on the fiscal and the monetary side, and the policy side. But it's in terms of what real cash is getting into the system, there's not much going in there. So it's a bit like the whole all fart no poo. But the property sector rallied its tits off today because people are again preempting another round of stimulus. But until it materializes, buy the rumor, sell the fact kind of job.
The other thing is that it's rallying off such a low base. It's ridiculous.
Well, exactly. Like people are getting all frothy over Evergrande being up 83%. It's a penny stock.
Yeah. Absolutely. I tweeted a 5-year chart of it this morning, and you can't even see the rally. It's so small because we've fallen such a long way. So yeah, I think as you always rightly say, zoom out.
Yeah, but like if I woke up in the morning and I was twice as tall as I was the day before, I'm still only 4 foot. So I'll get those in before anyone else does. We are starting to see like all these. We are seeing an increase in these measures. Like we're starting to see a bit like brickmanship coming back from China against the US in like the token measures, such as today's news about government officials banning iPhones. Now that's not really going to do anything. They're only doing that because of the Huawei or whatever. I don't see what I can't see what they're trying to do with that. But the only thing we can really say for certain is that there is pressure building on Xi. I think zero COVID policies that they had kind of broke the mindset of many in China, which before it was completely unacceptable to criticize the government or the policies or the regional governments. That's no longer the case. Don't get me wrong, they are trying to crack down on it, and they probably will do, but we are seeing more dissension than we've ever seen before. Does that mean that we're going to see policies changing somewhat? Not sure. No one can be sure of anything with China. If trying to get inside the mindset of the policymakers in China is a fool's errand. You can't do it. You can only really be reactionary to anything that materializes. People are suggesting that Xi appears to be aiming for like the slow and steady mentality. It's certainly slow in terms of recovery, but we're not really seeing the steadiness coming yet. So again, for me, I'd avoid it like the plague. Anything to do with China in terms of the investment front, if you want to have a punt, but admit to yourself that's all it is. There's no concrete stuff out there for me to trade off.
Yeah, I would tend to agree with that. Very messy and very noisy. Ioan, what are your thoughts around this kind of idea of, peak negativity? Is that close, or do you reckon there's more bad news to come?
I don't know. I think we're going to keep getting drip-fed stuff all the time, right? I mean, what you can't argue is that they're effectively turning Japanese themselves, right?
Yeah.
So they're experiencing a balance sheet recession. And that again is based on the property developers' collapse. They're not deleveraging. They tried to make it a consumer-led recovery, but it's just not happening like that. So, we're getting headlines now where they're encouraging new lending again. There's all these policy announcements. Like ultimately, I've seen some estimates suggest that it's worth about 1% of GDP. I mean, 1% of what percent of GDP are we talking about? I mean, is that a 50% increase in GDP, or we don't even know if China's growing, right? So, I mean, the thing is, everybody will look at China, they'll see a headline come out, everything will go like that. You fade that move, or you.
Well, right. So, sorry to interrupt slightly, but just really on this particular point. I remember, during the war, when we used to trade the headlines and stuff, and you would get a triple R cut, right? And all you would do is buy as much copper as you could on the on the CME futures HG, which I'm sure you can trade on Pepperstone. But, you would just lift that, and you're good for 400 ticks. Like what? Yeah, time it wasn't even and
you don't even hold it for a minute.
Exactly. But you don't get any of that anymore. You don't get any of it because everyone's like, well, so what?
Yeah.
Well, the thing is, everybody's layering into that as well now. As they say, it's hard to get
Exactly.
But no, I think what Xi is trying to do, he's trying to get rid of that China put, like the Fed tried to do with the Fed put. I mean, every announcement's greeted with stimulus, which is largely on the supply side. But I think moreover, she tends to agree that with those, especially in a Chinese sense. I mean, it's more there and probably in Japan or in the Far East than it is anywhere else. Is that things like welfare disincentivizes hard work and contributes to laziness. So who knows? I mean, that's where that's probably their thinking, but nobody really knows.
Exactly.
So
Trying to get into the head of that, it's just, there's people paid us absolute shit ton of money to give you like opinions on China, and they're getting it wrong every time. So know your limitations.
and we don't get paid $20,000 a month.
No, that's for sure.
That's me bar bill.
And the rest. Adam, we've spent a while talking about, the headlines that we're getting, and we get 4 or 5 a day that we kind of look at and ignore. What for you are the ones where, if they were to break, we should actually sit up and take notice and go, right, China's at a turning point, or the government are getting serious about this, or the PBOC have realised that there's a real issue? What would be those signs for you to actually say the narrative is distinctly turning?
Well, I think kind of Western expectations of what they want China to do relative to what PBOC and Chinese officials are willing to do are kind of two different things. I think over the past 10, 15 years, people have become more conditioned to the fact that if China wants to, it can just kind of unveil this big bazooka. But, the Chinese policymakers just don't really appear to be in that frame of mind at the moment. Part of the reason why we're seeing this kind of property crunch is because one of their stated objectives was that they wanted to kind of pivot away from being so reliant on the real estate market. And, the problem is they've possibly gone too far too soon, or it's just an objective which ultimately they're just never going to achieve anyway. So, yes, we've seen things like they're going to lower their mortgage rates, make financing easier for other companies. And then in some parts, I feel like they even risk of potentially overdoing it. I think was it Huangzi yesterday? They're going to ignore some credit checks for first-time buyers. It's like, we've seen that film before 2008. So it's just like, it's almost like their risk of doing almost kind of like overreaching now in the property sector. But I think ultimately, if you wanted a positive China story, I think some sort of reorientation away from real estate and then focusing on the things that they are actually doing well in a more consumer-led economy, which I don't know if they can necessarily achieve, but they seem to be talking up a lot of their progress on EVs, things like the chip sector, because obviously that has kind of, geopolitical importance as well. I think kind of, being able to be solid on that front is something that they kind of need to be seen. But don't forget as well, China's suffering due to the broader, terms of trade with the rest of the world. And, if the rest of the world slows down, it makes China's export business a bit more kind of curtailed. So I don't think there's anything other than potentially a big bazooka, which I don't think is forthcoming, which is really going to help things at the moment. I think they just kind of need to kind of wear this pain with the property sector, hope things go okay, and then hope the rest of the world can maybe help them out. I think, but the problem is that we talk about these, these property kind of developments on a day-by-day basis. In 12 months' time, we're going to be gearing up for the 2024 presidential election, and there's a certain Republican candidate where, when he gets on the campaign trail, he's going to very much reframe the narrative around China. And I don't think we're necessarily going to be talking about the property sector. We're going to be talking about, going back to the headlines from, 2018, about China and trade. So I think any kind of reprieve for China is going to be relatively short-lived. And I think, I don't think this bazooka is going to be coming. And I think, I don't see what, other than this piecemeal approach and stopping the rot, I don't think it's a real element of positivity around China.
So just quickly, just to follow on from what you were saying, kind of about imports, exports and stuff. So look, in terms of the Chinese onshoring process, which they're definitely pushing, right? They're definitely trying to do as much onshoring as possible, including the chips, hence the 7 nanometer chip or whatever it's called that was announced yesterday. Again, I think that's a massive, massive issue for Germany, because one of Germany's biggest export markets is China for the higher end kind of engineering stuff and the big order. And they're doing so go on.
So I think that didn't Germany's annual exports of cars to China fall from like 3 million to 1.5 million, I think. Yeah.
And it's not even just that though, is it? It's just all these really precision engineering stuff that Germany's famous for. That China didn't have the technical know-how to do it. Now increasingly we're seeing that. So it's like another nail in the coffin for the German economy.
Which you're taking no pleasure in. From following you on social media, you're devastated by. I can tell in the tone of your tweets.
It keeps me awake at night. I'm like sobbing in the corner.
No Schadenfreude.
What a shame.
Yeah.
Anyway.
We should probably get off that subject because we're going to end up getting ourselves in trouble otherwise. So let's move on to the next round. Thank God Dickie's not here because we could have been on that all day. Right. I want to talk about the dollar. Ioan, we'll kick off with you. If you look at the dollar index, which, yes, it has its flaws, and I might be being a bit lazy here, but the dollar index has now had 7 straight weeks of gains, which is the longest run of upside for the index since 2014, according to the back of the envelope maths that I was doing the other day. What do we reckon's driving the move? Why has there been so much love for the
buyers and sellers, mate?
Is it that dollar index? Is that the DXY? Is that what you're talking about? That one. Yeah. I mean, quiet summer. Where else are you going to put your money? The market. The market hasn't necessarily given up on the September hike. After the August jobs report. So, I think there's a 37% chance of a hike in the cycle of the next meeting in November. Remember there was a big BRICS meeting as well, and there was all these stupid headlines about de-dollarization and but you only had to look at SWIFT data and you'd see that it risen to a record 46% in July. So, and that came at the expense of the euro. So, like with the euro being so weak, the dollar was taking up the slack. But, the euro share actually slipped to a record low of 25%. So, and then if we go back to the BRICS themselves, obviously the Chinese and the Indians, or Bharatians, have we got to call it Bharat yet? Or
I don't think so yet.
Oh, okay, we don't know, do you? You just got to be careful. But they want to obviously internationalize the yuan and the rupee, but they're not going to do it at the expense of each other. So they're not going to endorse a rival. So, they're going to have to, stick to the dollar, or the dollar will continue in its current position. So I don't see any significant catalyst that has driven the dollar per se. The Japanese were net buyers of treasuries over the summer as well, so there was significant buying from that side. Whether that continues, I don't know. But we can talk about that in the next part of the segment anyway.
Yeah, it's an interesting one. Adam, would you agree with that? Do you think it's more a case of just weakness everywhere else and the dollar's kind of rallied by default, or is there actually a US exceptionalism story that's starting to play out a bit?
Well, when you're talking about the dollar index, you're in part basically talking about the euro dollar index. Euro is 60% of it. I think from the US, there's been this soft landing narrative. There's been more favorable yield dynamics, which, in themselves have probably been supportive. But yeah, I think it's more a case of weakness elsewhere. If you take euro, clearly the narrative around the euro's changed, in the last few months relative to the start of the year. We've seen the growth slowdown filter through into rate expectations for the ECB. That hike in September, which, at one stage seemed like it was a dead cert. It's about, 25-30% now? If they were to hike, you could potentially see some short-term support, but I think it'd be faded pretty quickly. And I think the market knows that, because I think they'd see any tightening from here on in just hiking into recession. And I think also you've got to be mindful of things like the energy moves that we saw yesterday. I think that would favour the dollar a lot more than it would the euro, given their net import status. But I think what will be the biggest move going forward, I think, is possibly the Japanese yen. I think Japanese yen's probably been guiding things. Dollar yen seems I think it's basically destined to test 150 to the upside, and then do we potentially get a test of some of those highs you saw above that level last year. I don't think there's anything really there will necessarily reverse course for that move. I think, we saw
150 being the level that everyone's mooting is the intervention point as well, isn't it?
Yeah. I mean, I'm not sure. I think like we'll see verbal intervention up until then. Whether we see physical intervention, it always kind of depends on the velocity of the move.
How many times have we seen in the past when we the market gets in its head that this level is going to be the line that kind of they protect or whatever, and not just in the yen but in the Swiss and all stuff. We see it everywhere, and then literally the market just like a magnet draws it there because everyone wants to see if they're going to do anything.
Well, and in a manner of speaking, we've all just done that, because in kind of end of July, start of August, everyone was saying 145, and then we got there and nothing happened. Now everyone's saying 150. So we just keep revising that mark slightly higher every time until we get to a point where we do get that message and that pushback, I guess.
But I think from a fundamental perspective, though, ultimately the move has taken place because there's been such a policy divergence between the Feds and the BOJ. So if they do intervene, I think they may be able to stop the rot, but they're not going to reverse the move until the BOJ does anything. And we've kind of talked on previous shows about their policy journey is very different to the rest of the world. They probably need to tweak yield curve control, abandon it, and then at some point next year they can start hiking rates. But like I've said, I think it's a previous show, by the time they're doing that, the rest of the world would be kind of at peak or cutting. And are the BOJ going to be hiking amongst that? Probably not. So I think that's why everyone's being so bearish on the Japanese yen. And therefore, I think, if you look at euro, the weakness there is kind of self-explanatory. We've talked about the yen. Then I think also the pound as well. I kind of feel like those two hikes are maybe a little bit overpriced now. I don't think we'll quite get them. We could potentially see some more sterling softness creep in. And all of this is just kind of, supporting the dollar. I think the only thing that can really support the, weigh on the dollar is if growth really decelerates. But even then, it's the world's reserve currency. It could get a safe haven bid. And then is the US really going to weaken in isolation against the rest of the world? Probably not. So I think it's more a byproduct of weakness elsewhere, as you kind of said, rather than necessarily outright strength for the dollar.
Yeah, and then of course in your latter example there, you're back to the whole dollar smile thing, where actually if we suddenly go risk off and we're in a global slowdown, then the dollar's going to rally as a result of that anyway, which of course for things like EMs is just going to make the situation even worse. Ryan, the stronger dollar is obviously bad news for you, given where you're going in a week or so's time, and given your status as the world's biggest sterling bull.
The biggest concern is doing my arse on the craps table, not the exchange rate. I'll give you a hint. Like what the rate at which I lose it isn't really much of an issue. Just quickly, whilst it's still in my head, what Adam made a very, very good point about the BOJ policy is so different to everyone else. It's a process to change the policy. They can't just go from what they're doing now to hiking rates. This is over. It's going to take months even if they wanted to, they have to do the slow and the progression, because otherwise they just lose all. I'm not saying central banks have much credibility anyway, but just you can't go from what they've got now to hiking. But anyway, but in terms of FX markets, obviously it's just less of the technical side, but in terms of just the trading side, people should be aware, and I'm sure most people are aware, that FX markets are probably up there with the hardest markets to trade because they're so efficient. They're the most efficient, apart from maybe Fed funds or something like that, which no retail trader is going to trade them anyway. But FX markets are so efficient because there's trillions of dollars of physical trades that go through these markets every day, or over a period of time. It's very easy for a retail trader to forget that side of thing and think that the FX markets only move because of bids and offers on a trading ladder. That's not the case. There's huge. You think when one government has to send some aid or whatever to another government, we're talking billions of dollars. Money does change on the cash markets. And a big company is buying another big company. Say a US company is buying a European company, they will change into euros, and just be aware that it is the hardest markets in the world to trade. It's whatever we say really in terms of directional trading ideas. at the end of the day, it's guesswork. Because if it was anywhere remotely easy, we wouldn't be on doing this. We'd be trading. Let's be honest. It's simple as that.
For yourself.
Well, exactly. Well, I've definitely stopped, which we'll get onto later in my bonus point. In terms of the central banks, as my two learned friends have said, they're completely data dependent, and what that means is that they currently have no idea what they're going to be doing at the next meeting, let alone the meeting after that, and not a clue on the meeting after that. What we're also seeing, which I think is interesting, and which is why I think we'll see some increased FX volatility, is the fact that the main central banks are becoming increasingly divided, as in the policymakers themselves have become, not as in the central bank, I mean the policymakers within central banks are becoming divided internally. So that's going to cause, again, more headlines, more volatility. There could be some very close calls in terms of when we're voting for hikes and keep it steady. This forget cuts for now. Gun to my head, if you wanted me to throw out some random ideas on markets, I would rather be, if I had to have a position in US dollar up here, I'd rather be short than long on the index, just because why not fade it? Euro lower. I just think they're in a massive issue. They've got massive issues going on now. Sterling, I'm not going to even entertain any option but higher. Kind of get real, people. Again,
I think with your sterling high, I kind of have a similar bias as well, because I think what we'll see is, I think short term, maybe it's a little bit overpriced for hikes, but I think 2024, I think we'll see a result kind of similar to what we saw at the start of this year, where the Bank of England is more of the hawkish outlier, but not entertaining cuts. And this kind of, was it the table mounting kind of approach?
Yeah. Well, and again, Europe is in a position, as we've said multiple times in the past.
Guys,
someone's.
I don't know whether you can hear the fire alarm going off again.
Do not use.
To our viewers, this is a commitment of how much Michael values your time. He can either stick it out or he can run off.
Michael, well, we can get through this pretty quickly.
So I am going to run off. We were going to talk about stocks. We were going to have Ryan get his bonus point. But instead I'm going to get burnt to a crisp. So thank you very much for watching Trading Blows. Thank you to the panel for joining us. And if I haven't caught fire, then I'll be back this time next week with the panel joining me.
Attention.
Bye.